Hello and thank you for tuning in to the Ascending Abundance YouTube channel, where I cover strategies on how to get rich quicker. Instead of saving a ton of money, I'd rather explore ways of making a lot of money, hopefully quickly, absolutely legally, and definitely in a shortened period of time. So this is a very basic strategy that I just wanted to cover. It's just selling put options on a super safe stock. I'm taking Royal Bank of Canada as an example, and in here I'm covering an example of a trade that I actually did yesterday. Whether it's going to turn out good or not, time will tell, but I walk you through it. So stock price of Royal Bank of Canada, this is Canadian dollars, as of yesterday was 137 bucks. It was a down day, volatility spiked a little bit, Royal Bank lost about $1 in the early trading. So I kind of looked around and I looked at the options pricing and just look at the 1 week, 2 week, 3 week. I don't want to sell the option exactly at the today's price. I just want to get a little bit of a discount. So I've settled on $134. That is just 2.2% below today's price. It is super simple. Obviously, the stock price could dip below this, but at least you're getting a bit of a discount. 2% on the Royal Bank. Hey, why not? If it happens, it happens. I'm willing to buy this stock if sort of the worst comes and the stock price goes down. So February 24th, and we're today in February 7th. Yesterday was February 6th, obviously. I've picked the 2-week-ish option because this it allows me to make a little bit more money than I would have done in a 1 week time frame. And I don't want to go a month. I would rather do these you get these turned around faster. I think I can make more money doing it this way, because as you go out, things change. There's a quarterly report that's coming out for Royal Bank in early March. I don't want to go into March because that will bring me a bigger premium, but also increases volatility and increases unexpected results. So with this February 24th, at least I'm making a couple of $100, and it's super simple to implement. If you don't know how to work with options, please listen in to other YouTube videos. I'm not going to go deep into the topic with all of the Greek letters and how does put option work and how is it executed. This is just a quick strategy, a few minutes that I can walk you through an example. Put premium on this particular trade at the strike price of 134 is 45 cents. It was the bid of 45 and ask 50 cents. I could have put 50 cents and waited, but my approach was, if I settled on a deal, if I see that the stock kind of kept on falling during the day and then kind of stopped, then this is the price that I'm going to get, and it's probably the better that I could. So I would rather do the trade and then wait and hope for the extra 5 cents on this trade. Sometimes I do wait, sometimes I don't. Depends on how the stock sort of performs and how I feel about doing this particular trade, how confident I am, and how much margin I got to implement. So one put, as a reminder, is 100 shares. So if 100 shares for one put equates to about $45 in premium received. I'm willing to go up to 500 shares on Royal Bank. So that would be 5 puts, and that will net me about $225 minus commission. Commissions are different for every broker. I'm using Interactive Brokers, and I'm expecting this commission to be maybe $5-7 or so. So 220 would probably be my net. What is my expected return? So the exposure of 500 shares at $134, if I am required to buy the stock at that price, would be $67,000. I'm willing to put that up. In fact, you can go actually lower. You can just say 30% of this amount is the required margin. So truly, you're just utilizing the margin that's available to you, not the entire cash. Cash continues to sit in your account. If there is interest being earned, an Interactive Broker actually pays interest. So you can continue accumulating interest. You can invest in other securities. So long as you got about 25,000, I would round it up. It's about a third of 67. If you have about 25,000, you're fine. You have enough cash or equity in the account to support this trade. So premium earned, as we said, $225. I'm just simply transferring this over. And the rate of return is $225 over the $67,000 exposure. Does not look like much. It's 0.34%, no big deal. But a reminder, this was 18 days till expiration. So if we do this every 18 days during the calendar year, so 365 days divided by 18 times this rate of return, so that's about 20 times a year. So if we can do this 20 times a year, that equates to about 6.8% rate of return. That is if, by some miracle, Royal Bank never ever dips below your strike price. You're never required to buy it. At the very least, you're making 6.8%. Not a huge return by any means. It is capital gain, so if it's a non-registered account, you are slightly ahead of the taxes. And it's definitely better than sitting with cash, and it allows you to purchase a really good solid stock if it does drop by 2.2%, not a huge deal. If we are required to hold it, I've put this little chart there. For the last 20 years, Royal Bank had its downturns and upturns, and sometimes it was stuck in this kind of rut scenario. So worst thing happens, if Royal Bank survives, and I believe Canadian banks are really positioned to continue surviving, their monopoly here in Canada, they're huge, they're really shy risk, they're solid in terms of their risk policies and exposures. So considering it doesn't die and it doesn't go into bankruptcy, the prospects of it recovering is pretty good. The worst case, you're going to hold it maybe for a year, maybe for two, collect that dividend, and dividend is about 4% yield right now. So I'm going to collect 4%. I'm going to be likely selling call options on that stock if I do buy it. So that, unless it dips a lot, like it dips to, let's say, 120, maybe low 115, if it goes like here to 100, then maybe I'm going to be stuck with it and I can't even sell call options. But in that case, I just hold. As soon as it approaches my strike price of 134, 130 even is good, I can start selling call options on it. So in addition to the dividend of 4%, I'm going to make at least maybe a couple of percentage points in call option premiums. So that gets me back to my 6-7% rate of return, even if there was a dip in the market. If there is no dip, I keep making this. The ideal scenario is if I start dipping in and out of the stock. So if it drops below 134, I have to buy it. I pocket my premium, but it dips just a little bit, maybe 133. So I sell a call, maybe at 135, maybe at 134.50 if those are available, or even at 134. I keep on selling those calls. If I'm lucky, I also collect the dividends. And in that scenario, you're likely to start making the premium in addition to any kind of upswing in the stock price from 134 to, say, I start selling calls on 135. Here's $1 that you could make. That's $500 per every transaction. Not too bad. So all in all, I do believe that this trade, if all goes well and nothing is horrible happening to Royal Bank, can easily net out 10 to 12% per year with the dividends and the call put premiums. So 10 to 12%, not huge, not going to make you rich, certainly better than nothing, better than just sitting on the sidelines and holding that cash. And your cash is still kind of available. Even if I buy $67,000 worth of Royal Bank, my equity or my margin is still largely preserved. It's only a third of it that is going to get eaten up by margin requirements. Everything else I am free to keep and continue using. So thank you so much for watching this video. Do subscribe, do hit the like button, and reach out if you have any questions. Leave a comment.